Bring in Richard Franulovich with Westpac to talk foreign exchange. Bring him in there right now. Come on in, Richard. Don't be afraid. It's like the whole stage is like one big cricket thing in Australia.
Hey, Tom.
How are you?
Good, and you?
I think I'm good. Europe, just your initial thoughts. What have you observed that's different in the last 48 hours in Europe?
Right, well, there seems to be a consensus forming there will be some kind of soft restructuring or reprofiling. A consensus building around that. Of course, there's no hard decisions being made.
Every time we say reprofiling, do we have to have another Foster's?
I think so. We do.
That's how it's going to be. Reprofiling? It's like,
you know what?
Big drinking game.
It's their favourite definition, but basically it involves extending the maturity schedule for these loans, which would ease the terms of the loan for Greece. And the sense that this is where the consensus is heading is what's helped Euro stabilise the last couple of days. But for what it's worth, there's still problems in the background festering. If Greece is in the situation where it is now, well, how about Portugal? The interest rate that they're looking at for their loan from the EU and the IMF is higher than what Greece has got.
That's an important point. I did not know that. That's amazing.
It's several percentage points higher. By the way, also in Spain this weekend, we have 13 of 17 autonomous regions having their local elections.
Where do you come up with this stuff?
You know, you read Bloomberg.
13 out of 17? You read Bloomberg, thank you. I think that was a shameless plug for Bloomberg. I love that. Let's do a rewind here, Richard, and see what Carl says. Earlier this morning on Bloomberg Surveillance, I spoke with Carl Weinberg of High Frequency Economics. I asked him about why Europe has been slow in working out any agreement for Greece or Portugal.
There are politics involved. I think Europeans are committed to the idea that no European government can be perceived to fail, and therefore they have to paint a picture around Greece's situation that makes it look less bad than it actually is. I think that kind of ego is a big player in the problems that we're having in getting to the right answer in all of this.
Carl Weinberg there, Sirius and XM, channel 113, like both. Now, they've reorganized or something. Sirius and XM 113. Richard, there's Carl talking about the politics of it, the reprofiling of it. What would you like to see this weekend, other than this very cool election set in Spain?
I don't expect any particularly aggressive
Nothing this weekend?
Not this weekend, certainly not. My feeling, though, is in the next few weeks, though, not this weekend, but in the next few weeks, you will see some kind of reprofiling of Greek debt. That will initially help stabilise the financial markets. The key issue here is for the euro is whether the European authorities can convince financial markets that any measures to stabilise the situation in Greece prevent it from becoming a systemic problem for EU banks. If they can convince markets that is the case, that they can effectively protect German and other European banks from a reprofiling, prevent an aggressive haircut, then that'll help stabilise the euro. But at the end of the day, there's still many other landmarks to cross. Ireland, Portugal, for example.
All right, you talk, I talk. Let's look at the market talk. Here's the recent trend, and it's not your friend if you're Jean-Claude Trichet. This is a spread. I want to walk through this because I had a wonderful note from someone that said, hey, Tom, you blather on like a pro. Would you please explain this? So let's do it. How do you measure a yield in a peripheral country? You measure it to the dominant power, which is Germany. So this is the German-Greece spread. I put the denominator first, or rather, it's you subtract them. You take the German spread, or rather yield, and you subtract, you take the Greece yield and you subtract the German yield, and you come up with 12 percentage points, and then they move the decimal over so they can act like they're fancy guys at Westpac, and you get 1,260 basis points.
Yeah.
The market's talking, isn't it? And you can see that line moving up.
Yeah, and that in fact, I suspect that's probably the 10-year spread. If you look at the 2-year spread, the difference between 2-year Greek sovereign bonds versus German bonds, that's more than 20% spread, which basically says that default is imminent.
How do you run a country that way?
It's the financing costs of running or taking maturing debt and reissuing at a higher interest rate, say 20% in a 2-year bond, is prohibitively expensive. That would consume virtually all of Greece's national budget, and hence why they're in an untenable situation and the need for reprofiling, rescheduling.
What are they waiting for then?
You know, it's a difficult situation. I suspect if they were to act unilaterally now, that there would be a catastrophe for the euro. The German banks, there's still a lot of this paper being held by the banking system. And so to the extent there is some kind of aggressive move by Greece in the near term, that would mean aggressive haircuts across the periphery. And as the European authorities have said, it would be a catastrophe in the short run. It would complicate the matter. It would be a messy situation that they're doing their best to avoid. I will say, though, that the alternative, which a lot of people talk about, which is Greece leaving the euro, that's equally unpalatable. The idea of Greece leaving the euro, moving into its own currency, which would probably be devalued by anywhere from 40 to 60%, would mean the effective value of their debt has exploded in euro terms. A weaker currency in Greek terms would mean probably a big surge in inflation, a collapse in real wages, a collapse in their domestic demand.
You just
that's
full
even
of good
worse.
news today.
Yeah, that's an even worse. That's a much worse sort of fat tail risk scenario for Greece than even staying within the euro.
Bring up chart 6, if you would, here. Rex, I want to look at this about the game theory out there. It's not a strong dollar policy. It's a strong Swiss franc non-policy. And that the Swiss really didn't ask for this, did they? The lower line there is a stronger Swiss franc versus the euro, really to break down to new Swiss strength here, possibly. I'm not predicting that. The Swiss didn't ask for this.
No.
So within the game theory, as that is an example, the game theory of core Europe and peripheral Europe, who should we be watching?
I would say keep your eyes on peripheral Europe. That'll dictate trends in the euro. As far as the Swiss is concerned, they have relatively healthy balance sheet, large external surpluses, an economy that seems to be recovering, doing quite well. It's weathered the crisis. So the euro relative to the Swiss, we expect to trade very heavily and ultimately take out 120. That cross has been trending lower for many months now, and there's nothing that's likely to arrest that trend in the near term.
What's your favorite trade right now? Where can we make money today?
You know, our big picture view at the moment is that increasingly as we move into the middle of the year, you're likely to see risk assets generally trading with a heavier tone for a couple of reasons. One, we're approaching the end of QE2, so there's less liquidity provision hitting the financial markets.
Right.
Secondly, you've also got China showing some signs of various leading indicators and activity indicators that it is slowing. Copper imports, coal imports, iron ore imports are all a bit softer. So anything that's sort of leveraged to the need to low volatility, liquidity provision and Chinese growth is likely to underperform. So I tend to think currencies like the Aussie, Kiwi, the dollar block, as attractive as these currencies are in the long run, are probably looking a little bit vulnerable into the new year, into the middle of the year, I should say.
I got to make some headlines here and get them in the timeout chair. You would short the Australian dollar here?
I would short it on strength. Not necessarily
nice
here, but any bounce into 108 at 110, a retest of the old highs a few weeks ago, it is probably a safe short in the short run. That said, structurally, the uptrend in this currency is intact.
Okay, you'll be able to keep your job. Richard Franulovich from Sydney in New York with Westpac Bank there on hedging. He can short the dollar, Australian dollar, but maybe he wouldn't.